Welcome to Exodus Chrono, your channel for clear, insightful, and educational content about cryptocurrency and blockchain technology. Whether you're a beginner looking to understand the basics or an experienced investor seeking deeper insights, hit the bell icon and join our community as we explore the exciting world of crypto together. Let's dive into today's topic. Liquidity. I will be explaining the full definition of liquidity in crypto and complete guide to understand crypto markets. Liquidity is a fundamental concept in financial markets, including the realm of cryptocurrencies, and it plays a critical role in the functionality, efficiency, and stability of crypto markets. In essence, liquidity refers to the ease with which an asset, such as a cryptocurrency, can be bought or sold in a market without significantly affecting its price. High liquidity indicates that an asset can be traded quickly and with minimal price impact, while low liquidity suggests the opposite, often leading to price volatility and trading challenges. In the context of cryptocurrencies, liquidity is a multifaceted concept that influences trading, price stability, market adoption, and the overall user experience. This essay will explore the meaning of liquidity in crypto, its importance, factors affecting it, and its implications in the decentralized financial ecosystem. What is liquidity in cryptocurrency? In cryptocurrency markets, liquidity describes how easily a digital asset, such as Bitcoin, BTC, Ethereum, ETH, or any other token, can be converted into cash or another asset without causing significant price fluctuations. Liquidity is a measure of market efficiency, reflecting the ability of buyers and sellers to execute transactions at stable prices. For example, if you want to sell one BTC on an exchange and there are enough buyers willing to purchase it at or near the current market price, the market is considered liquid. Conversely, if there are few buyers, you may have to sell at a lower price, indicating low liquidity. Liquidity in crypto can be broken down into two primary types: market liquidity and funding liquidity. Market liquidity refers to the depth of the order book on an exchange, the number of buy and sell orders at various price levels. A deep order book with many orders close to the market price indicates high liquidity. Funding liquidity, on the other hand, pertains to the availability of funds or assets to facilitate trading, such as the ease of accessing stablecoins like USDT or USDC to trade for other cryptocurrencies. In the crypto world, liquidity is not only about centralized exchanges, CEXs, like Binance or Coinbase, but also decentralized exchanges, DEXs, like Uniswap or PancakeSwap, where liquidity is provided through liquidity pools. These pools are collections of tokens locked in smart contracts that enable trading without traditional order books. Understanding liquidity in both centralized and decentralized contexts is essential for grasping its role in the crypto ecosystem. Why is liquidity important in crypto? Liquidity is a cornerstone of any financial market, and its importance in cryptocurrency cannot be overstated. Here are several reasons why liquidity matters. 1. Price stability. High liquidity reduces price volatility. When a market has many participants and a large volume of buy and sell orders, large trades are less likely to cause dramatic price swings. For instance, in a highly liquid Bitcoin market, a $1 million sell order is unlikely to move the price significantly because there are enough buyers to absorb the sale. In contrast, in a low liquidity market, the same order could cause a sharp price drop. 2. Ease of trading. Liquidity ensures that traders can enter and exit positions quickly and at desired prices. This is particularly important for day traders, arbitrageurs, and institutional investors who rely on swift execution to capitalize on market opportunities. 3. Market efficiency. Liquid markets tend to have tighter bid-ask spreads, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. A narrow spread reduces trading costs and makes the market more attractive to participants. 4. Adoption and trust. Liquidity fosters confidence in a cryptocurrency. Tokens with low liquidity are often perceived as riskier because they are harder to trade, which can deter investors and hinder mainstream adoption. Conversely, highly liquid assets like BTC or ETH are more trusted and widely used. 5. Support for DeFi. In decentralized finance, DeFi, liquidity is the backbone of protocols like DEXs, lending platforms, and yield farming. Liquidity pools enable users to trade, borrow, or lend assets seamlessly, driving the growth of DeFi ecosystems. Factors affecting liquidity in crypto. Several factors influence the liquidity of a cryptocurrency, and understanding these can help explain why some tokens are more liquid than others. 1. Trading volume. The most direct indicator of liquidity is trading volume, the total amount of a cryptocurrency traded over a given period. High trading volume typically correlates with high liquidity, as it indicates active participation from buyers and sellers. For example, Bitcoin and Ethereum consistently have high trading volumes, making them some of the most liquid cryptocurrencies. 2. Market depth. Market depth refers to the volume of buy and sell orders at different price levels on an exchange's order book. A market with a deep order book can handle large trades without significant price changes, indicating high liquidity. Thin order books, common in smaller or newer tokens, result in low liquidity and higher volatility. 3. Exchange listings. The number and quality of exchanges where a cryptocurrency is listed significantly impact its liquidity. Tokens listed on major exchanges like Binance, Kraken, or Coinbase benefit from larger user bases and higher trading volumes. Conversely, tokens exclusive to smaller or less reputable exchanges often struggle with liquidity. 4. Liquidity pools in DeFi. In decentralized exchanges, liquidity is provided by users who deposit tokens into liquidity pools. The size of these pools directly affects the ability to trade without slippage, price changes during a trade. Larger pools, such as those for popular pairs like ETH, USDT on Uniswap, offer better liquidity. 5. Market sentiment and adoption. The popularity and perceived value of a cryptocurrency influence its liquidity. Tokens with strong communities, real-world use cases, or institutional backing tend to attract more traders, boosting liquidity. For instance, stablecoins like USDT are highly liquid because they are widely used as a medium of exchange in crypto markets. 6. Market makers and liquidity providers. Professional market makers and liquidity providers play a crucial role in maintaining liquidity, especially on centralized exchanges. These entities place buy and sell orders to ensure there is always a counterparty for trades, reducing spreads and stabilizing prices. 7. Regulatory environment. Regulatory clarity or restrictions can affect liquidity. For example, a cryptocurrency banned in certain jurisdictions may see reduced trading activity, lowering its liquidity. Conversely, regulatory approval can boost investor confidence and trading volume. Liquidity in centralized versus decentralized exchanges. Liquidity operates differently in centralized and decentralized crypto markets, each with unique mechanisms and challenges. Centralized exchanges, CEXs rely on order books to match buyers and sellers. Liquidity on these platforms depends on the number of active users, trading volume, and the presence of market makers. Major CEXs like Binance offer high liquidity for popular cryptocurrencies due to their large user bases and sophisticated trading infrastructure. However, CEXs are vulnerable to issues like exchange outages, regulatory crackdowns, or withdrawal restrictions, which can temporarily disrupt liquidity. Decentralized exchanges, DEXs like Uniswap or SushiSwap use automated market makers, AMMs, and liquidity pools instead of order books. Users provide liquidity by depositing token pairs, e.g., ETH, DAI, into pools, earning fees in return. The size of these pools determines liquidity, and low liquidity can lead to high slippage, making trades more expensive. DEXs democratize liquidity provision but face challenges like impermanent loss, where liquidity providers may lose value due to price volatility. Challenges and risks of low liquidity. Low liquidity in crypto markets poses several risks. 1. Price manipulation. Thinly traded cryptocurrencies are susceptible to price manipulation techniques like pump and dump schemes, where bad actors artificially inflate prices before selling off their holdings. 2. High slippage. In low liquidity markets, large orders can cause significant price changes, leading to slippage. This is particularly problematic in DeFi, where small liquidity pools can result in costly trades. 3. Market inefficiency. Low liquidity leads to wider bid-ask spreads, increasing trading costs and deterring participation. 4. Exit risks. Investors holding low liquidity tokens may struggle to sell their assets, especially during market downturns, potentially locking them into unfavorable positions. Enhancing liquidity in crypto. Efforts to improve liquidity in crypto markets include liquidity mining. DeFi protocols incentivize users to provide liquidity by offering rewards, such as governance tokens or trading fees. Cross-chain solutions. Interoperability protocols like Polkadot or Cosmos enable assets to move across blockchains, increasing liquidity by connecting fragmented markets. Stablecoin integration. Stablecoins provide a stable medium of exchange, boosting liquidity for trading pairs. Institutional participation. The entry of institutional investors and market makers enhances liquidity by increasing trading volume and market depth. Conclusion. Liquidity is a vital component of the cryptocurrency ecosystem, influencing price stability, trading efficiency, and market adoption. High liquidity ensures that traders can buy and sell assets seamlessly, while low liquidity can lead to volatility, high costs, and reduced trust. Factors like trading volume, exchange listings, and liquidity pools play a significant role in determining a cryptocurrency's liquidity. Both centralized and decentralized exchanges have unique approaches to liquidity, each with its advantages and challenges. As the crypto market matures, efforts to enhance liquidity through DeFi innovations, institutional involvement, and regulatory clarity will continue to shape its growth and accessibility. Understanding liquidity is essential for anyone navigating the dynamic and rapidly evolving world of cryptocurrencies.